That's the beauty of buying a growth business, is the price that you pay for the business does not change. If I'm buying it at $210 and it's 5.1 trillion, that's it. I bought it and then the years went by. Time's gonna go by anyway. That's the beauty of investing, is time's gonna go by anyway. So why are you not invested in companies that are growing? Ladies and gentlemen, what's going on? Today we are talking about valuations. And I'm making this video for friends of mine who are saying, I hear about these stocks, you tell me about these stocks, but I want to know for myself. How do I know myself that this company is a buy? Because personally, I hear stock picks from everybody. I might be watching an interview. It's a billionaire. He mentions a ticker. You know what I'm going to go do? I'm going to go home. I'm going to go look up that ticker. I'm going to go do the research myself. And where does that research start? It starts with the valuation. I'm going to say, this is a good value for my money. It might be a homeless dude down the street tells me, hey, ABC, that's the one. I don't care. Guess what? I'm going home. I'm going to look up ABC and I'm going to find the valuation. I'm going to figure out with my metrics, my idea of what value is. And I'm going to decide this company's a buy, this company's not a buy. We are looking at Nvidia as our science project stock of the evening. Here we're doing this a little new. We have free form and we're going to be using the iPad. We're going to be using the computer. First, we are looking at the financial statement. This is the financial statement / forecast for Nvidia. Now, if you don't get anything from this video, the main thing you should get is StockAnalysis.com. Make an account, go pay whatever it is for the premium membership, whatever, because that's going to allow you to see the third year out here. You're going to get the full year 2029, and on different stocks, it might be 2028 is as far as they go. But you want to see as far out as possible with these companies because that is where our valuation is. That's what's going to tell us this company is a buy or not. It's looking into the future. And that's the first thing about evaluating a company is think of it like driving. When I'm driving my car, how much of the time am I spending looking in the rear view mirror versus how much am I spending looking through the windshield, looking ahead? I'm spending 98% of the time looking forward, and I'm spending 2% of the time looking in the rear view mirror. It's all about the future. The power of StockAnalysis.com is you're getting these forecasts from, on Nvidia, for example, you have 26 down here in the bottom corner. You can see that. We have 26 analysts that are giving us that 2029 forecast. So they're forecasting the revenue right here at the top at 671. They're forecasting the gross profit, the operating income, the net income, the EPS, all of that good stuff. Now, these are just forecasts from Wall Street analysts. They're not going to be accurate. Some of them are going to be too low. Some of them are going to be too high. But it gives us an idea of where the market thinks the company's going, because we can go even a layer deeper and we can do our own fully in-depth analysis of deciding what we think the revenue is going to be for the company. Now, that's a totally another video. This video is about looking at what are the analysts saying, what's the valuation they're coming up with, and does that make sense with where the stock is trading at? Does that mean the stock is cheap? Does that mean the stock is a buy? Whatever, right? That's what we're trying to figure out in this video. So, Stock Analysis, that's your first website. Your second website is FastGraphs.com. FastGraphs.com. I don't have affiliate links. Just go sign up for these. Pay for the $15, $20 subscription, whatever it is. You're going to get every dollar out of it. Trust me. So let's look at Nvidia on their financial statement here. So the first thing I want to do is I'm looking at the past because, like I said, I'm going to check in the review. I'm going to see if there's a cop before I go. And I'm going to look at the last couple years. So 2023 revenue was 26, let's call it 27 billion. Then we had 2024, 60 billion. So we jumped up 125%. Clearly something's going on here. Then we jumped up another 100% to 130 billion. Then we jumped to 65%, so 215 billion. Now here's something interesting because that jump from 60 to 130 and then 130 to 215, right? That's interesting because the growth slowed down dramatically. But let's look at the nominal number because now you're getting a nominal number that is showing you, okay, we went up about 70 billion from 2024 to 2025, and then we went up another 85 billion from 2025 to 2026. So the growth slowed down, but the nominal number still grew even more than the year before. So this is something to think about when a company is growing extremely fast, like Nvidia, like these other semiconductors, whatever growth companies you're looking at, is, okay, maybe the growth slowed down, but did the nominal amount of money that they made, did it increase from the year before? So as long as that nominal number increased from the year before, that's very, very bullish. So like I said, they went up 70 billion and then they went up 85 billion between 2025 and 2026. And then revenue is going to accelerate even more for 2027. Now we're looking into the future. So we got to take some, this isn't fact. It hasn't happened. But we're looking into the future, and the actual percentage growth is going to accelerate again from 65 to 81%. And look at the actual revenue, the nominal. So when I say nominal, I mean the actual dollar amounts. The nominal number is going to grow from 215 up to 391. 2028, we're going to have 40% growth from 391 to 551. Okay, so Nvidia obviously growing insanely fast. Now the question is, does the valuation make sense? Because a lot of times when a company is growing extremely fast, the valuation's already caked in. It's already baked into the cake. We want to say, is it still a buy today at today's price, considering these numbers? Because sometimes these numbers are out here and the market they're not appreciating it. And that's what we want. We want to find a disconnect where we see crazy numbers, we see crazy growth, and we see they're not appreciating what is happening here. So we can hop in and we can ride these couple years as we get these earnings coming out and these results happening and the company's executing and doing what we think they're going to do. Let's look at the gross profit. That's the next line here. So it started at revenue, then we have the revenue growth. That's what's beautiful about stock analysis. They tell you the growth right there, so you don't have to go in and calculate it yourself, but you have to know how to do that, obviously. And the next thing is the gross profit. Gross profit is the money that's left over after they pay what it costs to create that revenue. And what do I mean by that? Let's say you make a widget in the factory. What does it cost? The actual mechanics and the materials that you had to purchase from different vendors to create your widget that you're now selling for $100 or in Nvidia's case, $50,000, whatever it is. That leaves you with your gross profit. So right here, let's look at 2026. Gross profit is $153 billion. So that's what they're left with after they collected the $215 billion from selling their GPUs. But now that leaves you with your gross margin, 71%. That is a insane gross margin. That is like software level gross margins from a hardware company, which is amazing. All these things can create a company to have a higher valuation. And we'll get to that in a minute. But now you have to ask yourself, what's all the back end things that are happening with the business that had to happen as well to get this widget out the door and sold? So I'm talking about anything that's in the back end, so not directly involved with the creation of the widget. And those are going to be your operating expenses. On FastGraphs here, stock analysis, they don't show you it here, but on a normal income statement, you're going to see that as operating expense. And that is very, very crucial to pay attention to, because a lot of companies will kind of make themselves rich, as in like employees and different people high up in the business that are getting paid way too much money. And that'll destroy the actual money that's coming down, because we start at revenue and we come down at the end. And at the end, that's the key number, because that's the number that us investors get. And that's all the way down here at free cash flow. Back to operating income. Anybody in the back end, that's your HR, that's your office staff, things like that. Anything that's required to go on in the background of creating the widget, not directly making the widget, that's your operating expense. So now we're left with 130 billion. That is beautiful, because what that's telling me, when a company goes from a gross profit of 153 to an operating income of 130, that is a very small decrease nominally, think dollars. That is a very small nominal decrease that we're seeing. So that means their operating expenses are very little, which is amazing. That's what we want, because we want that number to stay as big as it can all the way down the income statement. So now we have operating income, $130 billion. Now you have net income. Net income is after you're paying your taxes, things like that. That leaves you with your net income. So net income is $120 billion. Now, the most important numbers on here that I always look at is, one, it's the revenue and the revenue growth. Then I'm looking at the operating income, and I'm looking at the net income. Then I'm looking at EPS. Your earnings per share is going to just be your net income divided by the shares outstanding. So the shares outstanding is here. This is also on StockAnalysis. This is under the statistics page. So the two pages I use the most on StockAnalysis is the forecast page, which is going to give you that first screen right here. And here is the statistics page. And these are the two pages I'm looking at for every single stock. So the statistics page is going to tell me this key information, which is your shares outstanding. So we want to look at the total shares outstanding. So 24.22 billion. Now, why is that important? Because when you look at your net income of 120 billion and you divide that by the shares outstanding, that's going to give you your EPS number of 4.77. That is really important when you're going that extra layer deeper that I said we'll make another video about, which is you're personally figuring out like, okay, I think they're going to sell this many widgets. They sell the widget for this much. That means they're going to make this much in revenue. And then I think their operating income is going to be this much. And then their net income is going to be this much. And then, all right, now I have the net income. Now, how many shares outstanding are there? I'm going to divide that by the shares outstanding, and I'm going to get an earnings per share. I'm going to get an earnings number. But when you're just doing this first level of evaluating a business, you just look at it right here. They're telling you 4.77 was the earnings per share for 2026. Earnings per share growth. This is the other very, very, very important number, is the growth of the earnings. Earnings can grow faster than net income grows. But now you say, but John, you just said that the earnings is just the net income divided by the shares outstanding, and that gives you your earnings per share. How can the earnings per share grow faster than the net income? They should grow in tandem together. But here's the thing. When a company does buybacks, they are shrinking the float. They are shrinking this number here of shares outstanding where it says 24.22 billion. They're slowly shrinking that number. And that's where this number comes in, which is the share change year over year, minus 1.11%. That means that the total shares changed in 1 year. They shrunk by 1%. In 1 year, they, boom, shrunk by 1%. And that's good for us because that means there's less people that are holding shares. There's less shares, in the pie. So if I have one share in the first year and then in the next year, they shrunk the amount of shares, guess what? My share is going to be worth more if the business is doing the same thing it did last year because we're dividing that net income by a smaller number. So if we keep shrinking this number, this 24.22, but net income stays flat or even grows, then guess what? The EPS is going to grow even faster than the net income. And that's what we want to see. So this is another very important thing I'm looking at, which is the total share count and is it shrinking year over year? So buyback yield right here, 1.11%. Shareholder yield, 1.59. So that's adding in the dividend into that. So now we have a share count shrinking year over year, which is beautiful. And we have shares outstanding, 24.22. Good stuff. So now we're going to look at the PE ratio. And this is the main way of valuing a business. This is the main way. This is the first thing you're going to look at when you're evaluating business is what's the PE? PE is the price divided by the earnings. If the price for Nvidia is $200, something like that, 210, divided by 4.77, that gives us a PE ratio of 26.73. Whatever the math is. And now what's beautiful about stock analysis is they're showing you into the future here. They're showing you into the future the PE ratio if the price of the stock stays the same and we start hitting all these earnings numbers, 8.96, 12.73, 15.84. If the price stays the same of the stock and we start getting all these earnings come in for the future years, then obviously our forward PE ratio is going to keep shrinking. So then we go to 23, we go to 16, we go to 13. And that's beautiful because that's telling us, hey, Nvidia is going to trade around, let's say you think Nvidia is going to trade around 25 times multiple, right? Because right now they're at 26. And then here on this chart, you're like, wait a minute. If the earnings grows to 15.84, there's no way it's going to still be at the same price because that would mean it would be a 13 PE ratio. There's no way it's trading at a 13 PE ratio. It's going to be trading at a 25 PE ratio. There you go. You just did your valuation. You just said that if you hold this stock for 3 years, you should be much higher because you're going to be at 15.84 times 25, and that's going to give you a much higher price than 210 or whatever it is today. That right there is telling you, okay, there's no way the PE ratio is going to be 13 in 2029. The stock's got to be higher. So now you can say, okay, maybe it's a buy. I don't know. Is it high enough to justify your money sitting in there? You got to think about every single stock as like a car in the NASCAR race, right? And you want to be in the car that's going to accelerate the fastest and move the fastest in a certain time frame. Now, moving along, we have the dividends per share. Obviously, we have a crazy increase. We went from 4 cents and we're going to 76 cents, $1.06, $1.20. That's cool and all, but we're not here for dividends. That's something for the boomers. We're here for the growth. We're here for the revenue growth. We're here for the earnings growth. We're here for net income growth. We want growth, right? Now the question is, okay, John, I get it. The PE ratio, maybe we want it to be at a 25 PE ratio, but how do I know if there's a company trading at a 40 PE ratio? Why did you buy that stock, John? You didn't buy the stock that's trading at a 10 PE ratio, because obviously a lower PE ratio is a lower value. It's a better value, right, John? Maybe not. That's where the growth comes in. You have to factor in the growth of the business into your basic valuation of what's the PE ratio. That's where the PEG ratio comes in, PEG. So PEG ratio is price divided by earnings, and then you divide that by the growth. Your PE divided by growth is going to give you a number. And that number, we want to be around a 1 PEG ratio for the forward PEG ratio. So there's 2 PEG ratios I'm looking at. I'm looking at the current PE ratio or PEG ratio, which is looking at the past, last year, what's already happened. But the main one I'm looking at is the forward PEG ratio. So the forward PEG ratio, I want to be around 1, maybe 1.2, 1.25. And the PEG ratio of last year, I could let that go to like 1.5, maybe 2. But around 1.5 is like, that's where I would want to be. So the forward PEG ratio around 1, 1.2. The PEG ratio for the past can be a little bit higher. So now why is that? Because if we're doing a forward PEG ratio, we're looking at the forward earnings. We're looking at the future, next year's earnings. And anytime we're looking in the future and there's growth, then our PE ratio is going to be lower. So that number should be lower than for our PEG ratio, our forward PEG ratio. What's the PEG ratio for Nvidia? Let's just do it here. All right, so let me just look it up. Okay, Nvidia, we're going to call it 210. Or get off my screen. Okay, we're going to call Nvidia at $210, right? So 210. And then we're going to say the forward, because we're looking in the future, is 8.96 in earnings. And I think that's actually going to be this year. I think the years for Nvidia are off by 1 year, if I'm not mistaken. So we're already technically halfway through 2027. Some stocks just have it that way. I don't fully understand why. That's just the way it is. But I believe we're already technically in 2027. So really, you could be looking at 2028 as your forward for your forward PEG ratio for Nvidia. So let's do that. Let's look at 2028. And we're going to call that for our forward PEG ratio. So the stock is 210 today, and we have earnings expected to be $12.73. So we're going to divide by 12.73. It'll pop up on the screen in a minute. I don't know why it's delayed, but it is. 12.73. So that gives us a forward PE ratio of 16.49. Let's call it 16.5, right? Now we're going to divide that by our growth, and our growth is at 42%. So 16.5 divided by 42, we're at a 0.39 forward PEG ratio. Nvidia is ridiculously cheap based on this valuation that I have created or that exists. So now we have to ask ourselves, why is it so cheap? Because I said I was willing to pay stocks that are at a 1 PEG ratio, and I thought that was a bargain, a deal. Now, the reason why Nvidia's is so cheap is because this growth number of 42% is insanely high. It's insanely high. And it's not going to maintain at that level. So the market is expecting Nvidia's growth to decelerate very quickly, rapidly. But I also think the market is still undervaluing Nvidia. Personally, like right now, I do. And so I think that, let's say they even were at 20% growth and they just grew at 20%. Then we do 16.5 divided by 20. Now we're at a 0.825 forward PEG ratio. That's still cheap, right? We just decelerated their growth from 42 to 20, and they're expected 2029 to be at 24%. So they're still above 20%. And maybe in the future they drop down to that 20% and they drop below 20%. I could totally see that happening, and I could understand it. There's a million GPUs that they've sold, and I'm sure they're going to sell a bajillion more, but you have to understand they're already at such a high number that they're selling every single year, because they have to sell these GPUs every single year and then some to keep the growth going. So I can understand where the market is saying, you know what, this is going to slow down. But in my personal view, I think it's not going to slow down as fast as maybe the market thinks, because maybe the market is thinking these GPUs, it's going to slow down so much that in fact it may even decelerate. Maybe that's where the market's at, and maybe I'm wrong. And maybe Nvidia is going to chill at 200 and drop down to 140, 160, 170. I don't know. We're going to see what happens. But I think the market is not giving Nvidia enough credit. I think that it's going to continue growing, but we're blabbering on about Nvidia too much. The point is, this is how I'm valuing Nvidia. I'm looking at the forward PE, and I'm looking at the growth, and I'm combining the two together. That's the beauty of the PEG ratio, is you're combining the PE and you're combining the growth. So you're combining a static number, a PE number. The valuation is just a very static, once in the moment. It's a snapshot in time. It's a photograph. Whereas the PEG, when you add in the growth, you're kind of looking at like a video, and you're looking forward in the movie, right? Now, let's keep looking at what else I have here. All right, so now let's go down to the valuation page. So we went over this page a little bit, went over the buyback yields. We went over the shares outstanding. I don't pay too much attention to the short seller information. I don't pay attention to the percent shares that are short. Unless that number is like insanely high, like 20, 30%, then you could get what they call a short squeeze. But that's not very relevant to our discussion today. So now I keep scrolling down on the statistics page on StockAnalysis, and you get to these different sections. So you have the valuation ratio area, you have the income statement area, and here you can see their forward PE. They're putting it at 21. They're putting the PE at 32. So you can see how when you look in the rearview mirror, the PE ratio is higher. But when you're looking at the forward PE, it's much lower because there's so much growth expected for the earnings. So when you're taking that higher earnings per share in the future and you're dividing it by today's price, you're going to get a lower number if the earnings are growing. And then you have the forward PS. So that's the forward price to sales. Now, price to sales is interesting when you're dealing with a business that doesn't yet have earnings. So when a business is so early on in their life cycle, then they may not have earnings that you can look at yet. Let's say they're negative 41 cents in earnings, and then next year they're going to be negative 25 cents, and then the year after that they're going to be positive 10 cents. Okay, it's hard to evaluate a company by looking at their earnings when the earnings are negative. The number literally doesn't compute in the calculator. It's negative. So you look at the sales, you look at the sales, the revenue. So the price to sales, the price to revenue. And Nvidia trading at 11 times price to sales, that means you're paying 11 times what they're making in the forward year. Now, what's interesting on this page that I do pay a lot of attention to is the income statement right here, because this gives me like a quick snapshot of that main information that I was looking at. So I'm looking at revenue, 253, gross profit, operating income, net income, EBITDA, EBIT. I'm looking at all of that. And I'm looking at the earnings per share, $6.53. Very cool. Balance sheet. This is very important. I'm always paying attention to this, especially with companies that don't yet have earnings, because I want to know, is this company going to have to dilute the shareholders? Is this company going to have a lot of debt to pay off in the future before they're able to start really making money? And could they even implode? Because a lot of companies will fail simply because they take on too much debt and they can't pay off the debt. Next thing you know, the company's gone, right? It's a penny stock. I'm looking at the balance sheet. Now, cash and cash equivalents. What does that mean? That's $53 billion. That means that Nvidia has $53 billion in cash or cash equivalents. Cash equivalents is like 3-month T-bills. So they're putting their money in a 3-month T-bill. They're collecting 2%, whatever it is, 1.5% on that money. It's as good as cash, pretty much, because in 3 months, they're literally going to have that money back in cash from the T-bills. So it's cash. It's what they have in the bank right now. Total debt, $12.8 billion. So that is interesting because I'm looking at, okay, their total debt is $12 billion, but they have $53 billion in cash. So literally, in a snap of their fingers, they could just go pay all their debt and literally have no debt. That's beautiful. And that gives you your net cash position of $40 billion. So that's one green check mark that I'm looking for in a business. Now, some businesses will have total debt that's more than their cash and cash equivalents. And that's not the end of the world. That's just like a semi-yellow flag, something to think about. And that's where you would have to go a little bit deeper into the business and ask yourself, is this company going to spit off enough cash in the next few years where, yes, their total debt is more than their cash today, but they're going to spit off so much cash in the next 2-3 years that it doesn't really matter. And that's where you would want to look at your free cash flow. And that's on the next page here. You have cash flow. Here we have cash flow, operating cash flow, $125 billion. Literally last year, they collected $125 billion in operating cash flow. So that means they did their business, they sold their widgets, and they collected $125 billion. Everything's paid off. This is what the business created, was the operating from the business. They created $125 billion. So very clearly, you could say, all right, obviously they can pay off all their debt very easily with literally 1 year's operating cash flow. $125 billion, and you have $12 billion in debt. What are we even talking about here? And then CapEx. This is very, very important. The next thing I'm looking at is what does it cost to grow the business moving forward? So CapEx, that's what that number is. So you have your operating cash flow, and then you're going to take out your CapEx, and then you're going to be left with the free cash flow. So the free cash flow, that $119 billion, that's the real number that they would be using to go pay off that debt. Realistically, you would look at the free cash flow when you're determining, hey, they have this much debt, but wait, they're going to make this much money in free cash flow next year. All right, that debt doesn't really matter. Or you may look at the free cash flow and say, man, they're going to have to really do something with that debt. They're going to either have to refinance it at lower rates or extend it out or something like that. That may be a red flag if their debt is so high that their free cash flow is not going to come in and cover that debt fairly quickly. And I'm not trying to buy businesses that is something I have to think about or worry when I go to bed at night, right? I want a business that's their debt is here, but their free cash flow is just absolutely cranking. So it's okay that they have some debt. They're going to pay that off fairly quickly. Not a problem. Now, the CapEx, this is very big. And this has been a story and a problem, sort of a problem for like the hyperscalers, like your Microsofts, your Googles, your Amazons. This CapEx has been a major thorn in their side because this is why these companies have been quote unquote struggling in the last year or so, is because they're spending so much on CapEx right now, literally giving it to this company, Nvidia, because they don't want to lose out on this AI race. And it is yet to be determined, I think, whether or not this CapEx is going to pay off. But all these hyperscalers think it is. So what these companies are doing is they're taking what would be their free cash flow, that 119, and they're absolutely demolishing it and eating it up in the CapEx. Let's say you have Microsoft, and Microsoft was doing so much in free cash flow before the AI stuff came on the radar, right? They're just cranking free cash flow. That's the money they're using for buybacks. That's the money they're using to increase their dividend. Good stuff for shareholders, really good. But then all of a sudden this AI thing came along and everyone's like, man, we got to buy these Nvidia GPUs. We just got to keep buying them. And they're looking at Amazon, they're looking at Google, and Microsoft's like, dude, we got to increase our CapEx. And when they're saying that, they're saying we're going to go buy more GPUs because we don't want to fall behind to all these other hyperscalers. So they say, screw free cash flow for the next couple years. We're just going to make less and less and less free cash flow. And we're going to dump that into our CapEx. We're going to up the CapEx number, right? Because if I have $125 billion in operating cash flow, but then let's say I upped my CapEx to $100 billion, then my free cash flow is going to drop down to $25 billion. Now, if last year my business did $119 billion in free cash flow, and then I'm telling the shareholders, hey guys, yeah, we're going to buy $100 billion of Nvidia GPUs. So our CapEx is going to absolutely skyrocket and our free cash flow is going to absolutely crater. Shareholders are like, wait, whoa, what are you doing? So the stocks of these companies, they kind of like are going flat, or they're even coming down because of this right here. This cash flow thing is so crucial. And this is what's causing your decline in Microsoft and Meta specifically. Google, obviously, they took off, but that's because that's a whole nother story. But anyways, free cash flow is another way to value the business. And I think in the long term, when you're looking at a business, if you really want to be honest, like super honest, you're going to look at free cash flow, and you're going to determine the value of the business based on the free cash flow. So what you'll hear a lot is free cash flow yield. Free cash flow yield is a percent of free cash flow to the market cap. Okay. When you're buying an investment, you're thinking about the ROI, right? So the ROI is like, oh man, I'm going to buy this Taco Bell and I'm going to make 15% ROI. That means you're going to make 15% return on investment every year, and hopefully you increase it. And free cash flow yield is that same number in a sense. So if I'm making $119 billion in free cash flow and market cap of Nvidia is $5.1 trillion, so I do 5.1 divided by 0.119 because I'm just keeping it simple on my calculator, but I'm doing 5 trillion divided by 119 billion. Sorry, I have that backwards. I'm going to do 119 divided by 5,100, right? So I'm doing 119 billion divided by 5.1 trillion, and that gives me a free cash flow yield of 2.3. So it's that same sense of I'm buying the Taco Bell and I'm going to make 15% ROI. It's that same concept. I'm going to buy the Taco Bell for $1 million. That's my market cap. And then it's going to make me $150,000 a year in free cash flow. So that means your free cash flow yield is 15%. Now with Nvidia, it's 2.3%, which is much less. So you're saying, wait a minute, John, that's way less. Yes, but the reason it's way less is because Nvidia has all this growth. It's not a Taco Bell. It's not going to have flat earnings for the next 10 years. It's going to have growing earnings. So if a company is going to keep growing and I paid this price today, the price you pay for a stock doesn't change. That's the beauty of buying a growth business, is the price that you pay for the business does not change. If I'm buying it at $210 and it's 5.1 trillion, that's it. I bought it and then the years went by. Time's going to go by anyway. That's the beauty of investing, is time's going to go by anyway. So why are you not invested in companies that are growing? Because as they grow, you're going to have more and more free cash flow, and you're going to divide that free cash flow number by the price you paid when you got in. So your free cash flow yield is going to increase. That's the beauty of free cash flow, and that's the beauty of growth businesses. And now what's the yield? You're like, all right, John, that's great, but what's the yield that I'm looking for? I don't know. That's a tough question. You have to think about the growth of the business. So how fast is the business growing? And I don't like to look at the percent free cash flow yield. I would rather look at the multiple. So I'm looking at the multiple of the market cap divided by the free cash flow. So I'm doing the opposite math. So I'm going to do 5 trillion, 5.1 trillion divided by 119 billion. And I'm going to get a 42.5 or 42.85. That's going to be my multiple, my free cash flow multiple. So I like a business. It's hard to say because when a business is growing, obviously I'm willing to pay more for that business. But the question is always, how fast is the business growing? So what I'll do is I'll think in the future, I'll zoom way out, I'll dream a little bit, and I'll say, all right, in 10 years, if I think the free cash flow is this, and I'm going to trade it at a 20 times multiple to that, which would be a 5% free cash flow yield, right? Then that puts the market cap at 10 trillion, 12 trillion, 15 trillion. And today it's 5 trillion. So in 10 years, I could triple my money, right? That's how I'm going to think about the free cash flow and the multiple to the free cash flow. Now, when a company gets above that 50 times, then that's going to put us at the 2% free cash flow yield. So I like to think about it more in multiples than I do in the free cash flow yield. But when you're looking at a lot of websites and things, they always show that free cash flow yield number because they're thinking of it like the Taco Bell ROI situation. Bought it for $1 million. I'm making $150K. My ROI is 15%. That's how they're thinking about it, which is fine. Both ways work. Next thing I like to look at right here, the margins section. I want to look at the gross margins. That's pretty important. But the main thing is how much of that is coming all the way down. So operating margin, I would say I look at the operating margin the most out of this section right here on margins. I look at the operating margin. So there's this thing called the rule of 40. Now the rule of 40 is when you take the operating margin and you add it to the revenue growth rate. And when that number is over 40, then it passes the rule of 40 test. And the beauty of that number of looking at the rule of 40 is you can put both a business that is later on in their life cycle and more mature, and you can also compare it to a business that's early on in their life cycle and less mature. Why? Because a business that's earlier on is going to have a higher revenue growth rate and a smaller operating margin because they're just getting started. They're just figuring things out and they're investing so much in the business that their operating margin is not quite there yet, but the revenue growth is making up for it. So when you add those two numbers, it might still pass the rule of 40. You could have a business that's growing at 40% revenue, but their operating margin is 0. They're literally not making money. Hey, they're at 40. They're passing the rule of 40. And you could have another business like a MasterCard, let's say, and their revenue growth is 9%, 12%, but their operating margins is absolutely massive at 60%, 50%. They're also passing the rule of 40. So that's kind of a neat little way, a neat quick number to look at. And I'll do that when I'm looking at businesses real quick. I'll say, okay, what's their rule of 40? Oh, they got operating margins at 20% and their revenue growth is at 25%. Cool, they're at 45. That's a pretty solid business, right? You have strong revenue growth and you have very strong operating margins. Now, then you have companies like Nvidia that are just absolutely stupid. 64% operating margin growth, and we were talking about growing the revenue for 2027, or what they write as 2027, at 81%. Next year is 40%. This is ridiculous. This is absolutely blowing past the rule of 40. So, great business. What's the next thing we're looking at? Right here, they give you the PEG ratio right here, the valuation section. PEG ratio, they have it at 0.47. But again, I don't just look at these numbers and just take them for their value. I want to go into the first page right here. This is the main thing I'm looking at. And I want to look at this and I want to figure this out myself, is what I'm saying. I want to say, okay, what's their forward PE ratio? What's their forward earnings expectation? Okay, let's take their forward PE. Let's divide it by the growth rate. You know what? Let's go a couple years out further and let's lower the growth rate. Is it still attractive? That's how I'm looking at the business. Now, the next thing we have is the financial efficiency. You have your return on equity, your return on assets, return on invested capital, return on capital employed. Those are all great things to look at. That's for another video. But the main thing I'm looking at here is the revenue per employee and the profits per employee and the employee count. So why is this important? Because when I'm looking at this right here, you will have businesses that will tell you what they expect for their employee growth in the future. And that's interesting because you might have a business that says, hey, we're growing at 20% and we don't think we're going to increase the employee count in the next couple years. We have no reason to increase the employee count and we see 20% revenue growth for years to come. What is that going to mean? That means much more profit coming to the bottom line, because what is the expense for every business? What is the main expense? It's labor, it's employees. So if you're not increasing your employees, but you're steadily increasing your revenue, what do you think that's going to do to your profit per employee? That's going to skyrocket. Now, this is obviously an insane number. We're looking at profits per employee of $3.8 million. That's insane. That's insane. Nvidia is insane. What can we say? Another thing on margin real quick is your free cash flow margin. So this is the percent of your free cash flow divided by your revenue. All these numbers in the margin section are divided by the revenue. So you take your gross profit, you divide that by your revenue, that gives you your gross margin, 74%. You take your operating income, you divide that by your revenue, you're at 64%. These percents are going to go down as you get closer and closer to the free cash flow because you're taking things out, right? You're taking out the cost of building the widget. You're taking out the cost of all the employees in the back end, your sales guys, your HR, whatever, secretaries, janitors, things that are going on in the background of the business. You're taking out your taxes, you're taking out your CapEx, and you're left with your free cash flow. Divide that by your revenue, and you're getting your free cash flow margin. 46.97%, 47%. That's absolutely insane. Again, we're dealing with Nvidia here. So now we're going to look at FastGraphs. FastGraphs is the other website I mentioned that you have to get. I cannot operate without FastGraphs. I just can't. I need it. Why do I need it? Because of this beautiful feature they have. So on FastGraphs, they have this feature where you can hit the forecasting button. And when you open FastGraphs, you put in the ticker, you click it. It's going to pull up this on the historical page, or maybe it's on the summary page. But I always just go straight to the forecasting page because that's going to tell me similar numbers to what StockAnalysis had. So here you have the number of analysts, 49, 47, 18. Those are your analysts, and they're creating the average from those analysts to give you these EPS numbers of 8.9, 12.3, 14.88. But the beauty of this chart is they're showing you the stock price in the black line, that's the stock price, in relation to these earnings. So you can see, and when you're on the website, it's even nicer because as you're touching on the stock price, it tells you what the PE ratio was at that time in history. You can see, oh man, Nvidia was getting expensive here because look, it was trading at a 50 times PE ratio. And then, oh man, Nvidia was cheap here because it was trading at a 30 times PE ratio. So you're not just seeing a stock going up and down. You're like, la-di-da-di-da. No, you're seeing the stock price in relation to the earnings, and you're getting a much more in-depth and colorful picture of the company. Because it's telling you, wow, Nvidia does not trade below that 25 times PE. So anytime the stock comes down to that 25 times PE, it bounces right off. And that's beautiful because when a company's growing so much, what is considered 25 times PE is constantly changing and going up. So we can see here, hey man, Nvidia is trading at 30, 32 times PE ratio. This is kind of on the low end of where it likes to trade. And obviously, as a company has growth that starts to decelerate, like we're seeing here, 38%, then 20%, right? And we're going from 59% to 86%, and then we're going to decelerate. Obviously, this might change a little bit where Nvidia likes to trade in that valuation range. So I love this feature. I absolutely love it, and I use it every single day because it helps me look at companies and say, you know what? I can see why the stock's going down. Look at what the analysts are expecting next year. They're expecting the growth to go from, let's say it's like 30%, and now they're expecting it to drop to like 6%. Of course, the stock's coming down. The market is anticipating this decrease in the earnings. That might be a situation that I'm looking at. So I understand why the company is trading where it's trading. And then let's say after it goes down to 6% growth, let's say the year after that, I see, oh man, the earnings are expected to shoot right back up to 30% again. So maybe the stock's in a temporary dip because some investors are looking at that massive decrease in the earnings and they're like, man, I'm out, I'm piecing. But me, I'm saying, you know what? This might be the time to get in because look, it's gonna take off again in the next year after that. So I'll sit in the car for 6 months, 8 months, a year, whatever it is, because I know that when that 30% earnings growth starts coming back, and if I think it's going to keep going after that, then I'm like, now is a great time because the market is looking at this temporary dip in the growth and they're devaluing the business now in anticipation of that. But I see into the future after that, and I'm like, man, it's gonna take off after that. So I'm saying the stock's gonna have to re-rate higher to keep up with this PE ratio. So also what's beautiful on FastGraphs is when you click on all these little things here, it tells you the stock price at that valuation at that time period. So you can literally put your finger right here at 38.47 times and it'll do it times 8.9 and that'll give you a number. That's obviously much higher than where Nvidia's ever traded at before. So this is what makes me like Nvidia, is because I'm looking at this and I'm saying, look where this company's going to be in 2 years. Assuming these analysts are correct. That's a big assumption too, right? Maybe these analysts are on the low end. Maybe the earnings comes in even higher. The revenue's higher. The earnings are higher. The net income's higher, right? Free cash flow's higher. Then guess what? This could be even higher. These numbers might adjust. These little dots, they might go up. Because if these numbers go up, the earnings, then these are going to have to go up to make sense with the chart. But I'm looking out here and I'm like, okay, because I want to say, you know what? Nvidia is not going to trade at a 40-50 PE ratio forever, especially with their growth dropping down to 20%. So I might say, let's say Nvidia trades at 26 times, 26.93 times in 2029. Then I'm going to put my finger here and it's going to pop up the number, or I can just go ahead and do the math. 14.88 times 26.93. I'll do it right now. And boom, I'm at a $400 stock in 2.5 years. That's the other beauty of this, is you can see, okay, that's 1 year, that's 2 years, that's 3 years, and we have 1, 2, 2.5 about. So in about 2.5 years, if I think it's going to trade at 26.93 times earnings and they do 14.88 in earnings, boom, I'm a $400 stock. That's beautiful, because right now we're at a $200 stock, 210. So I'm saying, man, we got 100% upside in 2.5 years. That sounds like a great return on investment for me. So that's how I'll look at FastGraphs, and that's how I'll use it. Now, right here, pay attention. We're under the adjusted operating earnings. So that's what is expected for the earnings. And this does not account for the stock-based compensation, and you might have some dilution. But now you want to look at, and you can change that. You can change that to the diluted earnings. And what's fascinating about that is I love comparing the two. So I'll look at this first. This is the main thing I'm looking at. And then I'll adjust it and I'll hit the tab and I'll look at the diluted earnings, because the diluted earnings tells me based on how many shares are expected to be in existence in those coming years. And that's going to affect your earnings, because the net income is not changing, but the amount of shares that you're dividing the net income by is going to change. So if we think in 2.5 years, the share count's actually lower than it is today because they're buying back so much stock, then when I look at diluted earnings, this number is going to be, these earnings numbers are going to be even higher. But it could also be the opposite. I might look at this and say, man, this is a great business. But then when I click boom here and I look at diluted earnings and I'm like, whoa, the earnings just got cut in half for next year. What's going on? Well, what's going on is a lot of stock-based compensation. So they're diluting the earnings. They're diluting the amount of money that's going to be divided amongst all the shares, because they're like, we're going to increase our shares, guys. Maybe it's stock-based compensation, or maybe it's they're going to have to dilute to get more capital because they want to do some acquisition of a business, or whatever reason they're diluting for. Obviously, you don't want dilution in the long run, but if there's some strategic reason why they're diluting, then it could be good, right? And companies that are very early on in their life cycle, they're going to be diluting. The question is, how much are they diluting and what are they diluting for? If they're diluting just for stock-based compensation, like a company like Snapchat, that's absolute crap, then I don't want to be a part of it. But if they're diluting because they say, we're going to go buy this other business that's going to be very synergistic and with our current business, and it's going to accelerate our growth and blah, 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 great, I'm all for it. But that's where you have to go dig deeper and listen to the earnings calls, listen to different conference calls, listen to any interviews, whatever you can grab on, go and eat that up. Information is your best friend investing in stocks. It is the only thing investing in stocks is information. Whoever has the most information and then the most courage and conviction, that's who's going to win in stock investing. So nice little tangent there. All right. Another tab you can click on when you click here is the operating cash flow. I love looking at this for businesses. So the operating cash flow, and they divide it per share here as well. So you can see your operating cash flow is 100%, then 39%, then 28%. And then you say, wait, John, why is the operating cash flow higher than the earnings? That's because they're probably doing a lot of CapEx. They're probably doing a lot of investing in the business. Remember, operating cash flow is not going to account for any investments the business is making to grow the business, right? I'm not talking about what they have to invest to keep the business going, to keep the machine running. I'm talking about what they're investing to make the business better, grow more, all that. So think of it like your operating expense in your car is your gasoline, your oil change. These are things you got to pay for just to keep the wheels going. But a CapEx expense might be something like, oh, I'm going to put these new tires on the car that's going to make it go faster. I'm going to put this spoiler on the car that's going to make the drag better, whatever. Anything that's like really going to super improve the car that's not a necessity for the vehicle to go, that's a CapEx. All right. So if let's say Nvidia is investing in, they need another factory or they need another whatever they got to do to grow the business in the future. Those are your capital expenses. That's not accounted for in your operating cash flow. But this gives me a clear idea on the business in general, because this tells me, all right, wow, the operating cash flow is going to grow even faster than the earnings. That means that the business itself is going to be on fire, right? I love to look at that. But I'm not really looking at it so much for the valuation aspect. I may, if a business is early on in their life cycle and they don't have free cash flow or earnings showing up yet, but they have operating cash flow showing up. So that might be a company like Nebius, a company like CoreWeave, where they have absolutely crazy operating cash flow growth because their business is growing and booming like insanely fast, but they're growing so fast that they're putting so many spoilers and new tires on the car and whatever things they're doing to make it faster and faster that they're saying, screw earnings, screw free cash flow. We need to grow. And you're seeing operating cash flow just absolutely take off, but you're like, they're spending so much that any money they're making, they're literally throwing it right back in to keep growing even more. And that could be a good or bad thing. Again, you got to determine that for yourself. You got to say, you know what, this company is going to be crazy big in the future. It's good that there's no free cash flow yet. Or you might look at the business and say, these people are absolutely nuts. I don't know what they're doing. There's no free cash flow. They got so much debt. They're not going to be able to pay the debt because they have no free cash flow, then stay away from it. You have to determine that for yourself. Anyways, we'll look at it here. So here we have the free cash flow. This is the last and most important thing that I'm going to look at on a business. Of course, it always comes back to free cash flow because at the end of the day, the buybacks is going to come from your free cash flow. They're going to shrink the float with free cash flow. And I have this dream, real quick tangent here. I have this dream that I'm buying a stock and I own one little piece of the pie, right? And then every year the company is doing buybacks and they're shrinking the pie down, till I am the last single shareholder. And guess what? If the company buys back so much stock that there's only one share left and that's you, you own the whole business. You get all the cash flows now. You get all the dividends. It's your business. The CEO answers to you. So that's a nice little dream that I have, is that I buy my shares and I never sell them, and the company keeps buying back all the shares, and then I end up as the one single shareholder, and I'm the 100% owner of the business. That's how you have to think about buybacks, because that's essentially what they're doing with the buybacks. They're making you a bigger owner, bigger and bigger every single year as they're shrinking the float. They're shrinking it down. And your piece of the pie it has to grow because you're a percentage-wise, you're a bigger piece of the pie. But you didn't even buy any more shares, right? So I always look at Warren Buffett and what he did with American Express, because American Express, he bought like 10, 11% of the business, right? He bought like 10% of the pie, and he's held it for so long. And American Express has done so many buybacks that his 11% of the pie is actually 17% of the pie. So that's just absolutely crazy. He's following my dream right there. That's very cool. So here we have free cash flow, and free cash flow, absolutely gangbusters. Again, this is after everything is paid for. You're going to see the free cash flow. So 136%, 40%, 27%, crazy growth. Now, the free cash flow is going to be you're going to see the company trade at a smaller multiple compared to the earnings and in the long run, because as a company matures, they're going to trade at a percentage of their free cash flow. So right here, you can see Nvidia is trading at, what is that? Maybe like 40 times free cash flow. Now, let's say I zoom way out in the future. I'm 10 years out in the future, and Nvidia grew 20%. They grew at 25%. They grew at 18% revenue, and the net income was growing, blah, 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 blah. And I'm saying, all right, way out in the future, Nvidia is trading at 20 times free cash flow. where does that put the stock? And if the stock is much higher than today, that's a good sign. That's what you want, obviously. So free cash flow is the last thing I'll look at. And really why I'm looking at free cash flow is because I'm trying to figure out where the business is in their life cycle. So like when I'm looking at Nebius or CoreWeave and their free cash flow is going negative, it's actually negative, it's not even positive yet. And then it goes negative even more the year after that. I'm like, man, this company's playing a crazy game because they're driving the car at 9,000 RPM. And what happens when you drive a car at 9,000 RPM for too long? Yeah, you're getting way ahead in the race, but you might break down. Your engine might blow up. So that's the idea of free cash flow is if a company's running negative free cash flow, you have to ask yourself, are they going to sustain this? And is the free cash flow going to inflect and turn positive in time before they have to pay all their debt or before the market says, you know what, this isn't worth it? And then they start devaluing the business. And then when they try to issue more shares to get more cash, they can't because the stock is much lower. So I'm getting a much deeper understanding of the business. And I think I said this earlier by looking at the free cash flow of the business. And remember what I said about the hyperscalers like Meta, Microsoft, where their free cash flow was going negative. Their earnings were growing on Meta and Microsoft. Their earnings kept increasing, but their free cash flow was absolutely getting demolished. When you let's say you looked at Meta and you're like, man, why does the stock keep going down? It keeps going down. And you're looking at the earnings and right here, you're looking at the earnings and you're like, the earnings look great. They're going to keep growing. I don't understand. Well, it's because you didn't look at the free cash flow because you didn't look at how much money they were taking from their earnings to invest into buying the GPUs and buying all the compute. And when you looked at the free cash flow, you saw, wait, we were growing 2024. And then all of a sudden 2025, we started dipping down. And then 2026, we dipped down more. And you're like, oh my gosh. But then you see on the chart, boom, free cash flow is supposed to explode in 2027, 2028, whatever it is. That's why companies like Meta, Microsoft, you see them coming down because the market is looking at their free cash flow and they're questioning whether or not it's worth all this money they're spending because the market's like, man, you could have given that money to us. That could have been buybacks, increasing my piece of the pie. That could have been my dividend. But instead, you're buying these GPUs, and I don't know why you're buying these GPUs. But maybe Mark Zuckerberg's right. Maybe Satya Nadella's right. And investing in all this compute is going to pay off in the long run. And hopefully they are right. The people who think they are right are buying Microsoft and Meta. The people who think they're wrong they're jumping ship from Microsoft and Meta. And that creates a market. And that's what's so beautiful about stocks. Anyways, that's my quick little long video about valuation and how I value businesses. Main thing, StockAnalysis.com. FastGraphs.com. Go create an account, pay the subscription so you can see in these future forecasting features that they have. And the statistics page on Stock Analysis, make sure you look at that. We went through everything pretty much. I mean, that's how I look at a business. I'm looking at the price of the earnings. I'm looking at the PEG ratio. I'm dividing the stock price by their future earnings. And I'm getting a PE ratio, a forward PE ratio. And then I'm dividing that by the growth. And then I'm getting a forward PEG ratio, and that's telling me how I feel about the business. And then I'm looking forward into the future, and that's where FastGraphs comes in. And I'm asking myself, where's this business going to trade in 2 years, in 3 years? Because if I think Nvidia is going to be a 38 times earnings in 2029, then boom, you're way up here. You're like a $750, $800 stock, and we're $200 today. Maybe that's what you think. And so I can see much more clearly with these two websites by my side. That's how I value businesses. That's how I look at stocks. And, that also helps with where I place option trades, call debit spreads, things like that. So if you like this video, make sure you like it. Make sure you subscribe. And check out feedmetrades.com. It's a website I made where you can track all of your option trades. So like I said, my call debit spreads, I put all my call debit spreads in feedmetrades.com, and it keeps track. It says, all right, you bought a 130 call and you sold a 140 and you paid $1.15 for that option, and that option maxes out at $1,000. It maxes out at $100 times 100. Or it maxed out at $10 times 100, so $1,000. And then once I close the trade, boom, I put it in right there, close the trade out, and I say, oh, I sold the trade at, I didn't hold it all the way. Let's say I sold it at $4. So I turned $100 into 400. That's great. And then boom, it keeps track in feedmetrades.com. You got to keep track of all your option trades. So you can also do covered calls. That's another beautiful thing about it. Put credit spreads, all that good stuff. Anyways, that's the video I got for you guys. Hope you found it interesting. Make sure you like, make sure you subscribe. Stay healthy, stay wealthy, and stay tuned for the next one. Peace.